New data from Golub Capital showing middle market private companies grew their earnings by double digits in the second quarter, giving investors a potential glimpse of what is to come for public companies this earnings season. Golub Capital CEO Lawrence Golub joins us here on set for more. Full disclosure, he is married to one of our traders.
Hi. It's not me. Sorry, Lawrence.
Lawrence, welcome. We're always
still hope,
to see you.
Tim.
I like to call you Mr. Feinerman, but we'll cut to the chase here. So we want to see what you're seeing, because this is a good indicator for what we are to expect from earnings season from the public companies.
This is a reflection of actual results of our portfolio companies, anonymized median, for the first 2 months of the quarter. So it's not a forecast, it's not a projection, it's actual.
It's what's happening.
It's what's happening, and it's very reflective of the U.S. economy, particularly outside the real estate sector.
Right. We are talking about the consumer. What are you seeing about the consumer? Because it looks like you were not expecting much. It came in a little bit better, but you're expecting some weakness still ahead.
I think Tim was spot on with his earlier comments. I think that the results at a 4% growth rate are actually better than I expected, but they're clearly weaker than other sectors. We're at a fork in the road in the economy. The excess savings, the stimulus money is mostly gone. And at the same time, we have a very high rate of job growth, over 200,000 jobs a month. And yeah, the unemployment rate's ticked up from a very low base, but you got wage growth, 3.5% or so, 4%, 200,000 jobs a month. That's $150 billion a year of growth in consumer income just by itself. But you have the offset of the reduced savings. And I think you're seeing a lot more strength and a lot more growth in private equity-backed companies outside the consumer sector than inside.
All right, Mr. Feinerman, I know you watch the show most days here. So we've been talking a lot about the underperformance on a relative basis of enterprise software versus semis this year. And we know what's going on, right? It's those semis that are exposed to generative AI and the like. And I know that you guys, in your portfolio, you have a lot of exposure there in the enterprise software space. What are you seeing as far as growth rates? Because this is one of the things I think a lot of us have had our finger on, that it might be the first sort of shoe to drop as it relates to enterprise spending in the tech space.
Well, I think growth rates have come down some, and in the private markets, in the PE-backed area, less than in the public markets. I mean, the public markets, enterprise software is down almost 50% in terms of growth rate, not in terms of revenue. We're seeing it down maybe a couple points, but still growing at 10% a year. And I think what we have is, customers are very sticky, but the number of seats, the cost per user, or the cost per user keeps going up, but the number of users has flattened out. And many customers are cutting a few seats here to add a few seats there. And so for the strongest players, they still have pricing power, and you see margins going up. For someone who's a player where there are 3 or 4 alternatives, the competition's getting a little nastier.
Lawrence, talk about interest expense and the burden of that, because one of the things you've noted in your letter is that these are decent times. Let's not get too carried away, because there is some building pressure. And this is something we talk about all the time. Higher for longer has a price to be paid. I'm curious, from the credit perspective, how you're analyzing these companies.
Well, we're a big fan of interest expense.
Yep.
I mean,
coming right to you. Yeah. So outside of the burden you're putting on those companies, but are you seeing pain, or is this something that, again, we've been expecting this and we've seen very little?
So there is some pain. The aggregates are great. The U.S. economy is doing really nicely. Private equity-backed companies adapt faster, make more changes, do add-on acquisitions. But those companies that have been weaker start to run out of liquidity eventually. And some of the laggards, some of them were laggards before COVID. Some of them are companies that didn't recover fully from COVID. A few of them are companies where the sponsor just paid too much. In 2021, there's some EBITDA adjustment indigestion. Maybe the adjustments didn't all convert into EBITDA. The margins of safety from the borrower's point of view are a little tougher. It's a different story from our point of view, because that margin of safety has gone from the borrower to us. And I think anybody should expect some uptick in default rates over time in an environment like this. We haven't seen it yet, but it wouldn't surprise me if it comes. That margin of safety shifting to the borrower, from the borrower to the lender is not a bad thing.
Yeah.